Each of us has been trained to believe, since we were kids, that money is very important. It is not the end, but it is the means through which you can see your responsibilities being fulfilled and dreams coming true. Investing is a risk versus return game. While some have made millions, many have lost as well. Here are key signs you are or can become a good investor. 1. You buy money-generating assets. If you think of stocks as ticker symbols bobbing around and decide whether to buy or sell based on price movements or what a chart looks like, that's speculation. If you're making money by trading currencies and commodities rather than valuing businesses or property, you're probably just getting lucky. Few investors, if any, can consistently make money by making macroeconomic predictions, but plenty have got rich by buying high-quality, cash-generative businesses when they are undervalued. 2. You learn from historical patterns. No investor is intelligent enough to look into the company's future without looking at the company's past performance. Whether you are looking at fundamentals of the company performance or you are looking at the price patterns emerging from the charts, the rule is the same. An intelligent investor is one who can identify past patterns, distill the wisdom from these patterns, and extrapolate these trends into the future. After all, your understanding of past trends is only useful as long as it allows you to extrapolate into the future. 3. You are a defensive investor. This may sound quite ironic, but it is actually true. Any investment decision is a commitment of time, money, and intellectual resources. An intelligent investor will use all these three resources very prudently. When you invest in a stock without adequate research and adequate conviction, you are not only wasting money, but also your time and your intellectual bandwidth. Unless you are absolutely convinced about an active investment idea, it always pays to adopt a defensive approach to stock markets. That is what intelligent investors typically do. 4. You allow time to work in your favor by thinking long-term. This is the classic pattern that intelligent investors follow. Good companies take time to become great stocks. They need to achieve economies of scale, perfect the business model, and be able to repeat their performance consistently and in a profitable manner. That is when company value actually gets translated into shareholder value. But for that, you need patience and an awful lot of patience. Unless you are willing to wait on stocks for periods ranging from 6 to 8 years, you cannot really consider yourself an intelligent investor. Only that will ensure the full play on the value of a stock. One thing that distinguishes good investors is that before a purchase, they ask themselves whether they would be content to own that company if the stock exchange closed and they could never sell. If you were going to buy a farm, you wouldn't be thinking about how much you could sell it for the next day. You would want to know how much wheat it could produce and how its earnings might fare over many years. The same should go for stocks because the intrinsic value of a business is based on all the cash it is going to throw off between now and Judgment Day. Remember, trading is the enemy. The more regularly you trade, the quicker fees and brokerage expenses will clock up and eat into your returns. 5. You admit to not being up to the challenge. Good investors stick within their circle of competence. If you don't have the time or desire to research stocks, there's nothing wrong with that. Stick your money in a broadly diversified, low-cost index fund and you'll outperform most active managers. The investors that get themselves into trouble are the ones that think they know more than they do. Good investors wait for the fat pitch, as Warren Buffett would say, and stick to simple businesses they understand. They don't swing at every opportunity thrown their way. 6. You diversify. Irrespective of what fundamental investors may say about the merits of concentration, there is a lot of business sense in diversification. It reduces your risk, and the fundamental step in any trading or investment activity is about reducing your risk. Above all, it makes your equity portfolio less vulnerable to micro and macro stimuli. In the process, you give up some portion of returns, but that is the trade-off, and it actually works better in the long run. Owning 10 to 20 stocks is enough diversification for most portfolios and reduces your exposure to company-specific risks, while still ensuring that you're concentrated in your best ideas. But good investors don't stop at counting the number of stocks. They also ask themselves whether they are exposed to a single sector or set of risks. Having half your money spread across each of the big 4 banks doesn't count as a well-diversified portfolio. 7. You look for a moat in the business. This is something we all have learnt from Warren Buffett. You create great stock market value when your company has a moat. What do we understand by a moat? It is that unique competitive advantage or special entry barrier that puts the company way above competition. At the end of the day, it is this moat that creates sustainable value and ensures that despite market vagaries and performance cycles, this moat sees them through. 8. You focus on price. The most important variable in any investment is the price you pay. If you are focused on valuing a company and figuring out the probable yield it will generate, you have the right mindset. Good investors aren't willing to overpay. They have a line in the sand and know that great businesses become poor investments if they pay too much. 9. You focus on management quality above all else. Intelligent investors focus on the quality of management. Is the management proactive enough to change with the changing times? Has the management created a reliable second line of defense? Does the management believe in high standards of corporate governance, disclosure, and ethics? All these factors have a positive impact on valuations and also tend to be value accretive from a market cap point of view. As Peter Lynch put it, a good management can handle a bad business, but a bad management cannot even handle a good business. That is what intelligent investors focus on. 10. You take a long time to form an opinion and longer to change. One of the hallmarks of an intelligent investor is that they take a long time to crystallize a view on a stock or a sector. They will meticulously evaluate the fundamentals, the charts, the business prospects, the moat, etc. For these intelligent investors, the investment view requires an investment of time and money. A truly intelligent investor actually takes a long time to form an opinion on a stock. Above all, they take much longer to change their opinion. It is this thoroughness and meticulousness that distinguishes a normal investor from an intelligent investor. 11. You admit to not being up to the challenge. Good investors stick within their circle of competence. If you don't have the time or desire to research stocks, there's nothing wrong with that. Stick your money in a broadly diversified, low-cost index fund and you'll outperform most active managers. The investors that get themselves into trouble are the ones that think they know more than they do. Good investors wait for the fat pitch, as Warren Buffett would say, and stick to simple businesses they understand. They don't swing at every opportunity thrown their way. 12. You are not carried away by hot stock tips and media recommendations. An intelligent investor will be not only judged by what he does, but also by what he does not do. For example, listening to tips, spending too much time on stock chat forums, and giving too much credence to media analysis are not signs of an intelligent investor. Typically, an intelligent investor spends more time reading, accessing reliable data sources, and crystallizing his view on the stock. It is too ambitious on your part to believe that you can actually end up as an intelligent investor on the strength of tips and recommendations.